Hi, hello everyone. Myself C. Netaji. Today we are going to see a topic called bills of exchange. This topic is very much important because this acts as a base for your inter and final stage. Based on this, we have many concepts. Everything will be learned at different stages. So yes, this topic is also having a real life scenarios. In the following session, I will explain you how this is applied in a real life business scenario and how SMEs and all the companies are making use of it. Yeah. The topic is bills of exchange. For your exam perspective, you have 4 to 8 marks, and I'm very sure you'll be able to understand this concept. World thinks it is a difficult concept, but I would like to ensure that within 1 hour you'll be able to understand the concept. And after attending the session, I'm very sure you'll be able to teach to another person. Yes. So bills of exchange. Let's wrap up. Now I'm going to explain the bills of exchange with an example. I want everyone's attention here. Yes. What is bills of exchange? What is promissory notes? How this is used in real life? Everything will be explained detail. I want you to give your 100% attention here. We are going to explain via an example. Example is, see, myself or we are collectively together. Netaji. Netaji is supplying goods to Mr. Ram of rupees 1 lakh. Is it possible whether the product has been sold on a credit? Yeah, obviously possible. So we sold the goods to Mr. Ram of rupees 1 lakh. When we go and ask on the next day, he said, sorry, sir, I can give back only after 90 days. We insisted that we need the money as of now itself. But he said, if you're very much particular about your money, you can take back your goods. Kana, any business will be run without profit is something suspicious. Yeah. Everyone will have a profit in their business. The purpose of business is to generate money. In this 1 lakh rupees, the product which we sold, we have a profit element of say 30,000. So when we insisted, Mr. Raman asked for giving back our money. He said, you can take back the goods. So if we take back the goods, our profit of 30,000 will be lost. We don't want to do that. So we asked Ram. So okay, I cannot take back the goods. We know that we have a profit in that. Alternatively, can you write in paper and give that you will pay me after 3 months? He said, okay, I can give you in writing that I will pay you your 1 lakh rupees after 3 months from the date. Okay. So what he is written in the paper or what we will write and get him signed is called as a bill. Bill is nothing but a paper. A paper is also called as a bill or also called as instrument. In accounting, if someone is mentioning it as instrument, it is nothing but a paper. Okay. Yes. So now we will see an example. Yeah. Hold on a minute. Yes. Hope my screen is visible. On 1st January 2025, Netaji sold goods to Ram rupees 1 lakh on credit, which is payable after 3 months. So we asked Ram to give it as a signing. Okay. So on 1st January 2025, on the date which he sold the goods itself, we wrote wrote in paper that 3 months after due date, pay to the order of us, Mr. Netaji, the sum of rupees 1 lakh for the value received in goods. Yeah. So person who is drawing the bill is called as drawer or maker. The person who is accepting the bill is called as drawee or acceptor. In our case, we are the drawer and Mr. Ram is the acceptor. Yes. So here is the bill or this is called as bills, bills of exchange. The whole concept is here now. They will mostly play with number of days here. Okay, so this is bill or instrument or a piece of paper or a piece of paper which it is written. Yeah? So date is very much important. And SD here denotes that ROM is also signed and person who we are making the bill. We also signed the bill and we got it. Okay. So recollecting everything, we sold the goods to Mr. Ram of rupees 1 lakh on credit. When we go and ask to the Ram, can you pay me today itself or tomorrow? He said, sorry, I didn't have money as of now. I can pay you only after 3 months. In this scenario, we asked Ram, okay, if you are not able to pay now, I can give you on credit. And in this scenario, I want you to get the bill signed. I want you to sign a paper stating that you will pay me after 3 months agreed period. Yeah. In our case, it is 3 months. So we are called as drawer because we only wrote the bill or the maker. Ram is called as acceptor or drawee. Okay. And there is one more person called payee. Payee can be either us, Netaji, or payee can be some person whom we direct to pay, whom maker directs to pay. Okay, pay can be either ourselves or the person whom we directs to pay. We will come back to our textbook. So we'll be running along with the textbooks side by side. So that after going home, if you recollect it, if you run through the textbook, it will be very much easier. Yes, we will directly get into a definition. All those points will be covering now. Don't worry. Yeah. Here they have given a bills of exchange has been defined as an instrument in writing containing an unconditional order. Okay. So now it is visible. Containing an unconditional order signed by the maker. In our case, maker is us, directing certain person to pay a certain sum of money only to order of a certain person or to the bearer of the instrument. Yeah. This is the definition given by bills of exchange. Yeah. An instrument in writing, I'm repeating it once again, instrument in writing containing an unconditional order signed by the maker, directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. Yeah. So here they have explained an example. We'll come back to our example itself. A bill check exchange has following characters. It must be in writing. Anything which is oral cannot be taken as bill check exchange. We are very clear here. So is it in writing? Yes, it is in writing. Okay, it must be dated. Is it dated? Yes, it is dated. We can give it as a blue color. It is dated. It must contain an order to pay a certain sum of money. Whether the sum of money is certain or not, yes. In our example, the amount is 1 lakh rupees. The promise to pay must be unconditional. The promise to pay must be unconditional. Once he signed it, it is unconditional. Yeah, before accepting, it can be conditional, but once he accepts it, it must be unconditional. The promise to pay must be unconditional. Here, there is no condition is here. It can be beautifully said. Anything which comes with conditional will not be fulfilled. Yeah? Something has to be accepted unconditionally, wherever. However, I hope everyone understands. Yeah. So coming back here, the money must be payable to a definite person or to his order to the bearer. This will be payable to ourselves or to the person whom we direct. The draft must be accepted for the payment by the party to whom the order is made. Whether Ram has accepted the bill? Yes, Ram has signed and accepted the bill. It should be properly stamped, except in case of bills is payable on demand. We will explain you what is on demand. Okay, later part. Yes, payment must be in legal currency of the country. Yeah, what is a legal currency? 1 lakh rupees is our legal currency. Rupees is our legal currency. Yeah, it is as per the definition. So the party which makes the order is known as the drawer. In our case, who makes the order? We, Netaji, makes the order. Who accepted the bill? Mr. Ram has accepted the bill. So he is called as acceptor. And the party to whom the amount has to be paid is known as payee. The drawer can be either us or to the person whom we direct, can be the same. Yeah. So any which is not an Indian bill is called as foreign bill. Okay. Now we will come to the journal entries. This chapter predominantly will place based on journal entries. No need to go for lectures at all. If you understand the journal entries, then you will get a knack of the subject. So when we make a sales, what will be the journal entry? On credit. When the goods are sold on credit, sale on credit or credit sales. Sorry, credit sales. So while making the credit sales, you will see ROM account debit to sales. How much we have sold the goods? 1 lakh rupees. Yeah, being sales recorded. Once the goods has been sold, what he said, Ram will come to our books as an asset. Now we are converting him as bills receivable. Bills receivable account we will be creating and we will be transferring the Ram to bills receivable account so that it will be distinguished from our regular Ram datas. Okay, being bills recorded. Once the bill has been recorded, what are the options available to Ram? Option 1. He can have the bill till maturity. On the third month, we will go and ask Ram, you have promised me to pay the amount. Will you pay? In this scenario, we will be having the bill till the maturity. Okay. Can hold the bill till maturity. Or option 2, I can give it give this to a banker and get the money from the day one of the bill. This is nothing but is also called as discounting with the banker. Okay. So what we will do, we will go and give it to the banker. Banker. Ram has promised me to give me so and so amount within so and so day. Can you give the money upfront? They will say, okay, I will give you the amount to you, but on a condition that I will charge a percentage of interest on that and I will take it. I will give only the rest of amount. For example, you're asking for 1 lakh rupees. I cannot give you the whole 1 lakh to itself because everything has a cost. So in this scenario, the average interest rate is 12%, which means I will give the money to you 1 lakh, but my opportunity cost of 12% per annum is getting reduced. So what I will do, I will for 3 months, if 12% of interest is charged per annum, which is for 12 months, what will be the interest for 3 months? It will be 3%. So in this scenario, what we will do, the bank will deduct 3% from the 1 lakh rupees, which is 3,000, and he will give us balance 97,000. Okay, this is option 2. Option 3, We have purchased the goods from some other person. So creditor, creditor X. We said XX. Ram has promised me to give me the amount. So I have an evidence of this copy. I will give it to you. Once he gives me back, I will give, or you can directly collect it from him after 3 months. So we can give it to a further endorse to another person. It is called endorsement. Endorsement of the bill to our creditor. Okay, guys, Ram is our debtor. I hope don't get confused. We sold the goods. So who our Ram will be? He will be our debtor. These are the three scenarios. So after this one, we have three scenarios. One is option one, hold till maturity. On maturity, what can happen? What could have be the two scenarios? Either he will say he will give the money or he will not give the money. Those are the two scenarios. So once he gives the money, it is called honoring the bill. Yeah, he's up to his word. He's honoring the bill. Honoring the bill means bank account debit to bills receivable account. We cannot give ROM here because already we have reduced the ROM and we have converted him into bills receivable. Yeah, this is on honoring. Okay, so this is on maturity while creating. On this one, in our option two, it will be discounted with the banker. Yeah. So in this case, we will receive the, okay, we have sold the goods on 1st January. So on 1st January itself, we will go and get it from the banker. Bank account debit. How much will be received? Okay. Interest or discount account debit to bills receivable to bills receivable account. Bank account, we will receive 1 lakh or 97,000. I didn't hear you. We will receive 1 lakh or 97,000. Yes. We will receive 97,000 here and interest of 3,000, totally 1 lakh. So bills discounted with the banker. Give me correct answer. You can think about it. Who will bear the interest cost? We or Ram has to bear the interest cost? Ram is very clear. I can give you only after 3 months. So we are responsible for this interest cost. But the businessman, how he will think is very smart team. I'm getting a profit of 25,000. With this 25,000, if I reduce this 3,000, I get a capital of 1 lakh. With this 1 lakh, I can rotate it 3 or 4 times. So with this 1 lakh, I can make around within 3 months, say another 1 lakh. We are multiplying the cash. This is how the businessman thinks. So he will give the paper and here getting a 1 lakh for which he's paying a charge of 3,000. So net profit will be for profit lemon say 30,000. It has been reduced to 3,000. So let's do 27,000. Similarly, we will multiply it many times. In accounting, we will give a paper and we are making money. This is how we have to think. Yes. So we'll give it to the bank. On the date of maturity, whether Ram has to give it to us or to the bearer of the instrument, to the bank. In this case, he has to give to the bank. On maturity, whether we will pass any entries in the books of Netaji? No. No entry because we have reduced it. And he has made the payment. So he will make payment of 1 lakh to bank. Everything goes well. We will not involve in the transaction. In the option 3, similar to the bank itself, but what we will do? say on 1st January 25, we are giving to our payable, okay, to Mr. X. So X will be our creditor. We are going to reduce X account. Yeah, to Mr. X account, we are going to give the bill. So X account debit to bills receivable account. How much will be 1 lakh? Yes. So here we have also reduced the books. We have reduced RAM from our book, and we have reduced our creditors also. On maturity, here also no entry. Why we are not passing any entries here? Because bills receivable has been transferred out from our books. Equally, our creditor has also been reduced. Mr. X has also been reduced. This is on maturity. Yeah. We are seeing only a simple journal entry to get in holds on grips how the bills has been received, how it will be matured. Yeah. So, till this, I hope everyone is understood. So recollecting everything. Once the goods are sold to Mr. Ram on 1st January, he said he cannot pay back today itself. So we are asking him to sign it in a paper. The paper is called as bill or instrument. So in that, it has to be very specific about the date and how many months he will be able to pay. It should be unconditional. Whom it should be paid, how much the value. It should be very certain. It should be signed by the drawer or maker. In our cases, drawer or maker will be ourselves, and acceptor has to accept it. Then there comes the third person called payee. Payee can be either ourselves, person who is making the bill, or the person whom we directs to pay can be third person. So once the credit sale is made, we will saw what is the journal entry, and when the bills are transferred to bills receivable, how it has been reduced in ROM and it has been transferred to bills receivable, and what are the options is available with the ROM available with us. Yeah, one we can hold till maturity, we can discount with the banker, or third one we can give it to our supplier and we can reduce our creditor. On maturity, what are the journal entries it will be. Yeah, this is an overview. After this, we will come back to the textbook. Okay, we have a promissory note. Yeah. Um. Okay. Before getting into a promissory note, I would like to explain one more thing. After seeing this, how many of you recollect, sir? This is similar to check. Yes, obviously it is similar to check. Check is an on-demand instrument. When you go and present it to a banker on demand, they will give us the money. But this has a tenurity of 3 months. That's it. So, so give us a clarity that whether check is a bills of exchange. Answer will be addressed at the end of the session. Back to promissory notes. So in bills of exchange, we make it. See, the person who gives on credit will draws the bill and ask him to sign it and get it. But in promissory note, the person who purchases will write himself that I will pay you after so and so day and within so and so amount. In our case, Ram will write it. That is called promissory note. Ram will say, I will pay you 1 lakh after 3 months to you. That's it. There will not be a third person called payee. And here is the difference. A bill contains order to pay. It is an obligation. A promissory note contains to pay a certain sum of money. Yes. Here involves the three parties. We know who is drawer, who draws the bill, who is drawee, and drawee is acceptor, and the payee. Here only the maker and payee. Here drawer and payee can be same. Is it possible maker and payee can be same? No. Because in promissory note, he is promising to pay me, so he cannot pay to himself. A bill is paid by the acceptor. A promissory note is paid by the maker. A bill is drawn by the creditor who sold the goods on credit. A promissory note is made by the debtor. The drawer and the payee may be same person in bills of exchange. Maybe because either he can pay to the drawer, the creditor, or to the direction of the person whom he insists. Here it cannot be. The liability of the drawer is secondary and conditional. He will be liable only in case of does not honor the bill. This we will explain in some when it comes dishonoring of bill. Bill we will explain you. A bills of exchange can be accepted conditionally. Where we saw is okay. A promissory note cannot be made conditionally. Here everyone will get a question, sir. In the previous thing, you have shown as unconditionally a word, but here it is showing it can be conditional. Yes, I will explain you here. So the promise to pay must be unconditional. Is promising to pay must be unconditional. Promise to pay. Repeat the word. Promise to pay must be unconditional. But when it comes to here, a bills of exchange can be accepted. Accepted by wrong conditionally. Example, he's promised to pay 1 lakh rupees. That is unconditional. But he will sign it or accept the bill saying that only if it is supplied on time. That means the transaction has to be end. So a bills of exchange can be accepted conditionally. The condition can be if the goods has been delivered within so and so date, I will pay you so and so money. But once it's accepted, it becomes unconditional. Hope everyone got the clarity. If not, I'll explain you once again. Yeah. A bills of exchange can be accepted conditionally, but the once the condition is fulfilled, it becomes unconditional. See, I will pay you 1 lakh if it has been sold, if it has been given to me within so and so time. If it is, see, the transaction has been completed as mentioned, then it becomes a bills. And once it is signed, it becomes unconditional. So here is the journal entry, how it will be recorded in their books, which we saw in detail, while discounting how it will be booked. Yes, if we are keeping till maturity, what will be the journal entry? If you're endorsing, what will be the things? Yes. Next, we have terms of bill. There is a two thing. One is after sight, one is after date. After sight is nothing but when the bill is written, it will not come from the date of return. From the date it has been given and accepted. For example, in our case, this is the bill drawn on 1st January, but it has been mentioned on site. Bill is on site. So then it has been signed by him on 4th January 25. In this scenario, the date starts from 4th January. Even though the bill is drawn on 1st January, after sight, after accepting, it is 4th January. After date means it runs from the date of drawing the bill. Here the date of drawing the bill is 1st January. Expiry date or due date. This 3 months is called as expiry date or due date. Days of grace. In India, we will never pay on time. So it has been entitled for 3 days of grace days unless it is an on-demand bill or it is on-demand or presentment bill. Okay. So 3 days will be added to this. For example, here this is 1st January and from this one we will add 3 months. Okay. January fully, February and March. March will be the ending. After that, we will add 3 more days. Okay. So Jan, Feb, March and April. April, what will be the date? April 3rd or 4th? You have to answer me. Whether the grace days has to be applied before or after. It has been clearly given. Okay. We read it across. I will show you. Hmm. Okay, it is in next paragraph. How to calculate the due date of the bill. Okay, I will explain you when it comes. Okay, so here this it will be given 3 days of grace days from the date of the expiry date or the due date. So this is the concept of due date. Days of grace will be three. Date of maturity of bill will be after adding the 3 days. On demand or at site or presentment. These three will not have grace days. If any word these three has been used, then it will not come under grace days will not be applicable to this. Bill at site, bill after date. Okay. Bill at site means that the instrument units, no time for payment is mentioned. So it is similar to on demand. Yeah, on demand at site presentment. Bill after that, after a specific period or on a specific day or after site. This is the regular bills of exchange. This is similar to a kind of check, bill at site. Whenever they come and give you the paper, you have to pay. It should have the word at site or at presentment. Yeah. So this one will be very much important. And most of the sums reveal around this concept, how to calculate the due date for the bills. And we have noting charges. Yes. The balance will be explained in now next chapter. We will next session. We will start from this in the next session. Yeah. So thank you so much.